Welcome to our channel, where we dissect trading techniques, strategies, and theories to make you a more skillful and proficient trader. Today, we'll delve into the most important component of technical analysis: support and resistance. Support in trading refers to a specific price level or zone that a market or individual asset has historically had difficulty falling below. The reasoning behind this is simple economics. As the price decreases, demand increases. This enhanced buying interest forms a floor or support level, preventing the price from falling further. Resistance, on the other hand, refers to a specific price level or zone that a market or individual asset has historically had difficulty rising above. It becomes less attractive to buyers, causing demand to decrease and selling pressure to mount. This pressure creates a ceiling or resistance level, stopping the price from rising further. Support and resistance levels are particularly important because they are levels where the price of an asset is likely to receive a significant amount of supply and demand. They are a crucial part of technical analysis and can provide you with potential opportunities to enter or exit trades. Smart traders often focus their attention on these areas, looking for signals of either a breakout or a reversal. Now, let's look into three types of support and resistance. Horizontal support and resistance. Swing highs and lows can serve as the most fundamental and intuitive form of support and resistance. These pivot points on the chart are where the price of an asset has reversed, indicating a shift in market sentiment and balance between buyers and sellers. The concept of horizontal support and resistance zones takes this a step further, building on the foundation laid by swing highs and lows. By connecting these highs and lows that are at similar levels within a narrow range, we can outline a rectangular zone on the chart. This zone represents the range where the price has repeatedly struggled to rise above or fall below. It can visually and analytically represent areas where the price might hesitate or reverse in the future. You can think of these zones as battlegrounds where a fierce war between buyers and sellers took place, indicating heavy trading activity at these levels. When the price is positioned above these zones, it acts as a support zone. Conversely, when the price is below them, it functions as a resistance zone. Trendline support and resistance. Trend lines are another essential method used to identify potential support and resistance levels. Unlike horizontal support and resistance that mark static price levels, trend lines consider and adapt to the direction of price movement, making them dynamic and especially useful during trending markets. First, let's discuss trendline support. This form of support is a diagonal line drawn upward, connecting at least two significant lows. It represents a level where buyers have previously entered the market and pushed prices higher, indicating an uptrend. When prices pull back, they often bounce off this trend line, helping traders to identify potential buying opportunities. Conversely, trendline resistance is a diagonal line drawn downward, connecting at least two significant highs. It represents a level where sellers have previously entered the market and pushed prices lower, indicating a downtrend. When prices rally, they often retreat from this trend line, helping traders to identify potential selling opportunities. Next, let's discuss the concept of trading channel formed when both trendline support and resistance are parallel to each other. This structure effectively captures the price movement between support and resistance trend lines. In this scenario, the upper line of the channel acts as resistance, while the lower line serves as support. Traders often find these channels useful for identifying potential trading opportunities, such as buying at the lower trendline support and selling at the upper trendline resistance. Trend lines can also help to visually assess the velocity and sustainability of price movements. A steeper trend line, where the price rises or falls sharply over a short period, typically indicating strong buying or selling pressure. However, with extremely strong market sentiment, there can be overextended price movements. In such cases, prices might be moving too far and too fast, potentially leading to less sustainable trends with overheated markets that could reverse or correct abruptly. The support or resistance levels created by such steep trend lines might be strong, but likely short-lived. These levels are often used for quick trend-following trades, but caution is advised due to the risk of sudden trend reversals following a breakout. On the other hand, a trend line with a gentler slope indicates a more gradual price movement. Such trends, rising or falling at a more sustainable pace, might suggest a more enduring trend. With a gentler slope, the market is less likely to be overextended, and the trend may be supported by consistent buying or selling interest. The support or resistance levels created by such gentler trend lines are typically more reliable and enduring, suitable for longer-term trend-following trades. Moving average support and resistance. The moving average is another one of the most common and frequently used tool in technical analysis. While they are typically used to identify the overall trend direction, they can also serve as dynamic support and resistance levels. A moving average smooths out price data by continually creating an updated average price, which can help traders identify potential support and resistance areas. Let's first look at moving average support. When the price is in an upward trend and continually bounces off a moving average line, that moving average is acting as support. Buyers come into the market around this moving average line, pushing the price back up. On the other hand, moving average resistance occurs when the price is in a downward trend and continually pulls back to a moving average line before falling again. In this case, the moving average line is acting as resistance. Sellers come into the market around this moving average line, pushing the price back down. Support and resistance levels can switch their roles. A crucial aspect to understand about support and resistance levels is that when these levels are breached, it can signal a potential trend reversal. This often leads to a phenomenon known as role reversal, where a broken support level becomes new resistance, or a breached resistance level transforms into new support. When a price breaks through a support level, that support level can become a new resistance level. The rationale is straightforward. Once the price has fallen below a certain level, that level may become a point at which traders are willing to sell the asset, creating a new resistance level. Conversely, when a price breaks through a resistance level, that resistance can become a new support level. Once the price has risen above a level where sellers previously dominated, it can become a level where buyers start to see value, thereby creating a new support level. Here are some examples of support becoming resistance. And here are some examples of resistance becoming support. This role reversal happens because market participants remember these levels and are likely to use them as reference points in the future. Traders who missed their initial trading opportunity might decide to enter the market if the price comes back to these levels, reinforcing their importance. Factors determining strength of support and resistance levels. The strength or significance of support and resistance levels is not uniform and varies based on multiple contributing factors. Identifying the strength of these levels is crucial, as it can profoundly impact your trading strategies and decisions. To gauge whether a support or resistance level is strong or weak, consider the following key factors. Number of touches. A basic principle is that the more times a price touches a support or resistance level without breaking it, the stronger that level is considered. Each touch further confirms the level's validity and increases its significance. Volume. Volume is another critical factor in determining the strength of a support or resistance level. If a significant amount of trading volume occurs at a particular price level, it is likely to be a strong support or resistance level. Price level history. The historical significance of a specific price level is a key indicator of its strength as a support or resistance. A specific level that has repeatedly acted as a turning point and barrier for price movements over an extended period is more likely to be stronger. Time frame. The time frame of the chart being analyzed can significantly impact the perceived strength of support and resistance levels. Generally, the higher the time frame, the more significant these levels become. For example, the strength of support and resistance levels on 4-hour chart is stronger than on 5 minutes chart. Market psychology. Round numbers like 100, 200, 1000 or numbers with many zeros often become psychological support or resistance levels because traders tend to place their orders around these levels. These levels are considered stronger due to the psychological bias of market participants. Previous role. If a level has acted as both support and resistance in the past, it is likely to be a stronger level. This is due to the role reversal principle discussed earlier. Price reactions. How price reacts to reaching a certain level can also give clues to the strength of the support or resistance. If the price reverses direction sharply upon reaching this level and moves quickly and far away from it, it suggests a strong level. Fundamental factors. Even though support and resistance levels are primarily a technical analysis concept, fundamental factors can also influence their strength. These factors can intensify the market's response when prices reach a support or resistance level. For example, a key interest rate decision, policy change, or significant news event occurring as prices approach such a level can trigger a strong breakout or a sharp reversal. This convergence of technical and fundamental factors can further reinforce the strength of these levels. Confluence of levels. Sometimes, several different methods might identify the same or a very similar price level as potential support or resistance. For example, a 200-day moving average might coincide with a horizontal support level, or a Fibonacci retracement level might line up with a trend line. These overlapping or confluence areas often serve as particularly strong levels. Remember, support and resistance levels are crucial in identifying potential price reversals and trend continuations. By recognizing and understanding these zones and using them in conjunction with other indicators or technical analysis tools, you can make well-rounded trading decisions. Thank you for watching this video. Feel free to drop any questions in our Telegram group, and we will do our best to provide answers. Engaging with fellow traders can also provide valuable insights and different perspectives. As always, trade smart, and we'll see you in the next video.